Good day, economic students. The purpose of this online video instruction lecture is to discuss the financial crisis of 2007 and 2008 brought on by the housing collapse and the relationship between the financial system of banking and mortgages and the housing industry and how it plagued the entire U.S. economy. Before we get into the particulars about the 2007-2008 financial crisis, we must explain the traditional mortgage process so you have an understanding of how things worked prior to the time when everything went kapooey. All right, so let's go back in time to U.S. economic history when we were a little bit more sane about the process of borrowing and lending when it came to home ownership. So the traditional mortgage process was pretty straightforward. You had the bank and you had the borrower, right? So the bank would only lend the borrower money if the borrower had three things. Number one, good credit. Number two, a reliable and definitive stream of income. And three, a down payment for the home. So if you didn't have those three things, there's no way you were buying a house. Let's use some simple numbers to explain exactly what we're meaning here. So let's assume that there's a house selling for $50,000. Back in the olden days, and this isn't really that long ago, but back before things went out of whack, the home borrower, the home buyer, needed to have a $10,000 down payment. That is to say, 20% of $50,000. This person would then be mortgaging $40,000 against the value of the home. That's where the bank comes in. The bank lends you the $40,000, 80% of the home's value. Now, typically, that $40,000 was borrowed in a 15, 20, or 30-year fixed mortgage. Amortization schedule, you can look all that up in your finance classes. But the idea is that if you did say a 30-year fixed mortgage, your payment would be the same every month for 360 months, 30 years times 12 months. And every month, a little bit more would go towards principal and a little bit less towards interest. That's how those mortgages work. So this was a good arrangement for both the bank and the borrower. The borrower got to purchase a home that they didn't have the money for, right? The borrower had $10,000 saved, but didn't have $50,000 saved. The bank realized it was in their best interest to grant a loan to somebody with good credit and against an asset where if the person were to default, it really wouldn't be that big of a deal for the bank because the house is worth $50,000 and the borrower is only in debt for $40,000. This relationship between homeownership and financial and economic success led to a classic economic fallacy that the government became guilty of deploying, and that is causation versus correlation. What we mean by this, it means this. Okay, very simply that if the government saw that people who own homes, they built wealth faster than people who rented. People who own homes, they achieved high levels of educational success, such as college degree or graduate school. People who own homes got married and stayed married longer. They stayed in jobs longer. They built money in their 401k or 403b retirement funds. And the government saw these statistics and they've said, wow, this would be great if we could get more people into home ownership because we would have more Americans achieving these types of financial and economic success. So the government encouraged a new type of borrowing which would expand home ownership to a larger demographic of Americans. In theory, this sounds like a good thing. The government's actually trying to do good by people. The government introduced what was called the subprime mortgage. And the subprime mortgage is exactly what it sounds like. People who don't have perfect credit, who may not have the money for a down payment, would be offered mortgages and they could buy homes. These were typically your renters. Now, some of those people would actually do really well with buying a home, but unfortunately some of them wouldn't, because if you're living at the margin, it might actually be better, it might be in your best financial interest and your best economic interest to continue renting a home. Now, the banking community reacted as we would expect when the government encouraged this idea of subprime mortgages and lending to less than perfectly credit-worthy customers. The banking community decided, well, we don't want to hold all of this subprime debt in-house. So banks figured we could securitize loans. We could create what's called the mortgage-backed security, which means this. Let's use simple numbers. Let's assume a bank lent $50,000 to 20 subprime borrowers. That adds up to $1 million in debt, right? 20 borrowers, $50,000 each. That adds up to $1 million debts. So the bank is holding $1 million owed to it by the subprime borrowers. The bank figures, okay, instead of holding the risk in-house, we could package these mortgages together and sell them off as a financial instrument to anyone who wants to purchase them. Now, who would be interested in purchasing them? Well, the subprime mortgages offered high financial returns because the interest rates were higher. So investment banks were interested in purchasing them. Maybe somebody who had a diversified portfolio of financial instruments would be interested in purchasing them. Maybe other banks would be interested in purchasing them. But you understand the idea of what's called securitization. That is to say, bundling mortgages into a package and selling them off piece by piece as financial instruments. Securitization is not only limited to mortgage-backed securities. It's been a common practice among the financial community for years. And in theory, it actually does reduce risk, right? So here's what happened. It actually misaligned incentives because banks thought, hey, we are eliminating risk because we're not holding the loans, right? Now, it led to a little bit of a problem because here's what's happened. Banks created mortgages. They then packaged these mortgages into securitized mortgage-backed securities, and they sold them to investment firms, which may have been okay until the next step when banks actually lent money to these same investment firms. So think of what's happening here, right? The mortgage is the underlying financial instrument which is holding this whole cards of house together. A brokerage firm buys mortgage-backed securities. They buy those financial instruments, and then they borrow money from the same bank that sold them the mortgage-backed securities. And in a way, banks were facing a triple threat because, number one, they actually held some of the subprime loans themselves in-house. Number two, they made loans they lent money to the investment firms who purchased the subprime mortgages. And number three, banks actually purchased some of these subprime mortgages for themselves because they met capital requirements for the bank. So, in comes what's called the collateralized debt obligation, a new derivative instrument. And in theory, this added more security to the system. These were akin to insurance policies against the possibility of defaults for the mortgage-backed securities, for the subprime mortgages. So AIG was the company who created most of these in the U.S. economy, right? So you think like, okay, I'm actually going to reduce the possibility of risk because we're selling insurance against the possibility of default against the subprime mortgages, which are packaged into the mortgage-backed securities. All right. Now that's called a derivative instrument. The idea that one financial instrument derives its value from another financial instrument. If all this is sounding a little bit complicated, that's okay. If you think you're having a little bit of trouble understanding it, just review this video. But it got far more complicated than this. If you have the time and inclination, there's a good movie called The Big Short that explains that these collateralized debt obligations were only one layer of the insurance. There were credit default swaps and other kinds of collateralized debt obligations and derivative instruments, and it got much more complicated. Can you see this leading into a problem? Well, in 2007, we started to have a problem. Lax lending standards were a big contributor to the problem. Right? Banks were getting paid to create mortgages and sell them off. They were incentivized to not even worry that much about the credit worthiness of their customers, because why do they care? They're not even holding a majority of the risk anymore. They're selling them off. Right? Investment banks, they saw these as easy ways to make money, so they kept purchasing them, and more insurance and derivative instruments created to allegedly backstop against the possibility of default. And this became worse and worse and worse until we reached 2007, when a few things happened simultaneously, which became the perfect storm. Number one, home prices started to fall. Now, home prices started to fall at the same time interest rates started to rise. Many of these subprime mortgages were adjustable rate mortgages, not the nice predictable mortgage of the olden days with the equal payment over 360 months of 30 years. When interest rates rose, it made subprime monthly mortgage payments more expensive, and all of a sudden, many of these borrowers started to default. It also created a dangerous situation where we had many borrowers who were underwater. What does it mean when a borrower is underwater? It means that the value of the home is now worth less than the value of the loan against the home, the size of the mortgage. So think of it in these simple math terms. I owe $300,000 on a home that's now worth $220,000. Many of those borrowers decided, why even keep paying? And they simply walked away. This created a major problem for banks. Here we see this triple whammy, right? Where banks, they were holding some subprime mortgages themselves and they weren't getting paid. Banks had made loans to investment firms, and remember, those investment firms had purchased subprime mortgages and they weren't getting money from the subprime mortgages, so they started to default on the loans. And banks also invested in subprime mortgages themselves. They held some of those very same mortgage-backed securities, which ironically was supposed to add their capitalization position, or we would say their liquidity position, but it actually made it worse. And now you can understand why things became such a mess. So, what happens? We have this collapsing house of derivative cards, right? Nobody wants to catch the falling knife. Nobody knows what these mortgage-backed securities are worth. The entire system begins to fall. You have to remember that the banking system provides the lifeblood of the U.S. economy. There are small mom and pop shops, manufacturing firms, tiny corporations that depend on liquidity in the system. They borrow every month. They use the cash to pay for operations, such things as salary and paying the utilities and paying for supplies. These firms generate a large amount of revenue because of their operations, selling goods and services, and they typically easily pay back the loans at the end of the month, and the entire process starts over again. The financial crisis was threatening to choke off the lifeblood of the economy. That's where the Federal Reserve and our federal government had to step in to rescue the day. So, the federal government created a program called TARP, Troubled Asset Relief Program. TARP allocated $700 billion to make emergency loans. It was one of those programs where if we don't get this done by the end of the weekend, we won't have to worry about coming to work on Monday, because there will be nothing left to rescue. Things were getting that desperate, right? So TARP lent money to the very same institutions who had caused the problem to begin with. This sounds kind of strange, ironic, and definitely frustrating to say, oh my goodness, the government lent money to the financial firms who were responsible for creating the problem. Now, it also creates or introduces a new issue. This idea of moral hazards. The government bailed out Bear Stearns, but let Lehman Brothers fail. This idea of moral hazard is that we don't want in a capitalist system our federal government picking winners and losers. It seems like they're playing favorites. No one intended to do this. A long story on how this happened, but Bear Stearns was just lucky that they asked for assistance prior to Lehman Brothers, and there's many other issues at stake. So, here's the ironic thing about TARP. It is actually the most profitable government program in the history of the United States. At the end of the day, what the banking system desperately needed was enough liquidity to get them from today to next month, and from next month to next year. Once the system was up and running again, banks became profitable once again and were able to pay back the loans. In simplest terms, think of it like this. Let's say you owed somebody money on January 31st, and you had $5,000 due on January 1st. Now here's the problem. On January 30th, you don't have $5,000. All you have is $5. But you know that come April 1st, you're going to have $50,000. The problem is you have no way to get from January 1st to April, right? So think of a TARP program as a bridge of liquidity that allowed the banking system to survive their dark days to make it through to more profitable days. And interestingly enough, it became the most profitable program in government history. So, one of the most interesting aspects of this financial crisis was the role of the Federal Reserve. So, we define the Fed as lender of last resort. In a previous video, when we talked about the functions of the Fed and what the Fed is supposed to do for the economy to keep us and help us achieve full employment domestic output with low inflation, the one idea is the Fed is the lender of last resort. This term was broadened to new horizons during the financial crisis. Prior to the financial crisis, the lender of last resort was a rather straightforward idea to explain. And it meant, okay, when a bank was short on reserve requirements, or a bank looked mildly insolvent, or a bank was having trouble with liquidity, they could turn to the Fed and they would borrow money. And they typically borrowed money only overnight and paid it back. Now, sometimes it would borrow a little bit longer. Now, the typical size of the loan that the Federal Reserve, our nation's central bank, would make to a commercial bank or a thrift would be in the neighborhood of $150 million. Now, $150 million sounds like a lot of money to me and you, but in the banking system, it's not that much money. During this period, when the Fed extended its role as lender of last resort, it was making billions and billions of dollars worth of monies available. And it created these new programs. Primary dealer credit facility, term securities lending facility, asset-backed commercial paper money market mutual fund liquidity facility, commercial paper funding facility, the money market investor funding facility, the term asset-backed securities loan facility, and finally the newly introduced program of the Federal Reserve paying interest on reserves. Wow, that's a big expansion of the Fed's role as lender of last resort. It did amazingly well in helping the U.S. economy survive the 2008 financial crisis. Interestingly enough, we are asking the Fed to revisit its role of lender of last resort now that COVID-19 has unfortunately forced the U.S. economy to hit the pause button. Through no fault of their own, small, medium-sized, and large businesses have been forced to shut down. The Fed is providing the necessary lifeblood to get us from pause to restart. So we haven't gotten through the woods yet, but we're hoping that the Fed's lending program will provide a lifeline of economic security for firms that at the moment are incapable of operating because of quarantine regulations. One issue with the Fed's lender of last resort is that it calls into question the Fed independence. Theoretically, the Fed is independent of the political process, and this independence is touted as one of the strongest characteristics of the Fed, that the Fed takes measures to manipulate the nation's money supply to sustain full employment, domestic output with low inflation without political bias. Inevitably, when the Fed loans money, these lending programs could be judged as prejudicial towards the outcome of maybe one type of firm or one type of industry or specific companies within specific industries. The Fed is doing everything in its power to avoid this label, but their actions could be interpreted as biased. So what was the result of the financial collapse of 2007-2008? Well, we had the Wall Street Reform and Consumer Protection Act, aka Dodd-Frank, right? So it was passed to stop these practices that led to the crisis, right? It's interesting though, because nobody, or hardly very few anybody, went to jail. Most of the, we'll say, the baddies got a slap on the wrist. Some of them didn't even get that, right? And ironically, critics of this program say it actually went too far. Yeah, it was insane during the 1997 through 2007 era, when all you needed was a pen and a pulse to get a mortgage, and lending standards had become completely laxed. At the same time, is it really necessary to make a person who has 10 plus years of paying their mortgage on time jump through hula hoops if and when they want to get a new mortgage or refinance their old mortgage? It's a really good example of cost-benefit analysis and government regulation, and how well-intended government regulation, it's still difficult to get the level of regulation correct to please all interested parties. That concludes this video. Look for another video in the future on macroeconomics. Good day.